Hi, it's Phil Hodgen, and welcome to the International Tax Lunch. We do this International Tax Lunch thing every second Friday of the month at noon Pacific time, except when it collides with a tax filing deadline, as it did this month, in which case we move the date around a little bit. So today we're going to talk about expatriation, the tax consequences when you give up U.S. citizenship or you give up green card status. Today's topics, this is what I'm going to cover. First, I'm going to give you a quick flyby, how the whole process works, how this law is set up conceptually, step 1, step 2, step 3, and then we're going to talk about what happens if you're a particular kind of taxpayer called a covered expatriate. Quite generally, when people give up U.S. citizenship or a green card, they are either an expatriate, defined term in the code, in which case they have a bunch of paperwork to file, principally Form 8854, or they are a covered expatriate, in which case they have the same paperwork plus a little bit extra, and they have potential tax liability. So expatriate, paperwork; covered expatriate, paperwork plus tax problems. So we're going to talk about that. Then we're going to dive into a couple of topics that need some little bit more exploration. The first one is a seemingly simple one. What's your expatriation date? You're going to give up citizenship or you're going to give up your green card. What exactly is that date? This is a very important date because that's the date on which you no longer are a U.S. taxpayer taxed on your worldwide income. So it's important to know that date, and it's not entirely clear for citizens, although it is clear for long-term residents, green card holders. So we're going to explore that and tell you how you should fill in line 5 on Form 8854 on the first page. What's the magic date? And then we're going to talk about this covered expatriate beastie. If you are a covered expatriate, a taxpayer, what happens to you? How do you become one of these things? And there are some tests, 3 hoops you have to jump through, and there are a couple of exceptions. We're going to work our way through that and help you understand how this whole thing works and how it fits onto the particular part of the Form 8854 that you're going to have to fill in. Finally, I'm going to talk about strategy. How can you prevent yourself from becoming a covered expatriate? And if you are a covered expatriate, how can you at least mitigate some of the damage and reduce the tax liability that you're likely to face? So let's start with the overview, how it works. You start with the fact that you are a citizen or a thing called a long-term resident, defined term in the code. So a citizen is someone who holds the magic passport from the United States. Long-term resident is basically somebody who has a certain immigration status, lawful permanent resident, so green card holder for short, and they have that for a long enough term. So the first important thing to understand is there are only 2 categories of people who have a potential problem with the exit tax, and everybody else has no problem. So if you are in the United States with Category E visa, Category L visa, Category H, H-1B, you do not have the problem of a potential exit tax if and when you leave the United States. Well, so you're a citizen or a long-term resident. Something happens, your expatriation event, that changes your status from citizen to non-citizen or from long-term resident to not. And what is that event? And as I foreshadowed briefly, when did that happen? One way or another, if you start as a citizen or a long-term resident, you have the magic expatriation event that's defined in the code. You are an expatriate. So status plus event equals expatriate. But you're not finished yet. You know, here you have the Form 8854 to fill out and log yourself out of the U.S. tax system. But you still don't know whether you have a tax problem as well, whether you're a covered expatriate or just a regular old ordinary expatriate. And to determine that result, you need to look at 3 tests, and we'll talk about them in depth, and a couple of exceptions to those tests. And if you fail one of those tests, you're a covered expatriate. So any one of the 3 failures will make you a covered expatriate. If you pass all 3 tests, you're just a regular old expatriate. And here are the results that you face as an expatriate, covered or not. Someone who is a covered expatriate, the right-hand column, files the final tax return for the year of expatriation, Form 8854, Form W8CE. So this is a new member of the W8 family of forms that you give to pension administrators and people like that. And you notice there's a potential tax liability for the expatriate. And another one is the recipients of gifts or inheritances from a covered expatriate may face a tax. For someone who's not a covered expatriate, the paperwork problems exist. Final tax return, Form 8854. The Form W8CE is not required. CE is code word for covered expatriate, so that's your clue. And critically, there's no problem with paying an income tax for the privilege of leaving the U.S. tax system, and there's no problem leaving inheritances to your U.S. heirs if that's what you choose to do when you die. So here's a little note for the paperwork and where the requirements come from, the code or this Notice 2009-85. And let's move on to a quickie discussion of how the income tax liability for covered expatriates works. There are 4 different little mini rules. So even though we just say exit tax is a hand-wavy kind of methodology of describing what happens in Internal Revenue Code 877A. In fact, there are 4 different buckets that you have to work with to decide what the actual tax liability is for the covered expatriate. So the first bucket is these things called specified tax deferred accounts. So these are specified in the code, and for simplicity's sake, let's just think of IRAs as the example. If you're a covered expatriate, you have a deemed distribution from your IRA without an early distribution penalty. So you have a giant whack of ordinary income as you leave the United States. You get basis in the IRA, so you don't get taxed twice on the distribution. The second category is called deferred compensation. And for simplicity's sake, think pensions, defined benefit pensions if you like. And there are 2 different categories of these defined compensation items. One's called ineligible and one is called eligible. If you have ineligible deferred compensation, then you calculate the present value of a lump sum distribution of all your future benefits and you pay tax on it immediately as you leave the United States. If you have eligible deferred compensation, then there's a withholding tax imposed from distributions as you receive them when you retire of 30%. This is not the tax, this is just the withholding. You calculate your tax as a normal non-resident alien because that's what you are after you expatriate. Now, what's the difference between an ineligible deferred compensation item and an eligible deferred compensation item? Well, the clue lies in this withholding thing. So you think about how the withholding rules work. We have a withholding agent who is given the job of withholding tax on payments to non-resident aliens, and the withholding agent sort of has the sword of Damocles hanging over his head. It says, if you screw up the withholding, you personally are liable for the tax. So an eligible deferred compensation item is an item of income where there is a withholding agent that the IRS can go grab, strangle by the neck and say, no, you pay because you screwed up. So what it ends up being is that you have domestic pension plans are going to be the eligible deferred compensation items because there's a domestic withholding agent, and foreign pension plans are going to be ineligible deferred compensation items because you think about the pension plan administrator sitting in Argentina making pension distributions. What happens if the pension plan administrator says, nah, I'm not going to withhold U.S. taxes and remit it to the IRS? What can the IRS do realistically? Absolutely nothing. So that's why the government wants all the tax up front in this deemed present value lump sum distribution calculation. The third category is trust distributions. A covered expatriate who is a beneficiary of a non-grant or trust, foreign or domestic, has 30% withholding on the taxable portion of trust distributions pay as you go. Again, it's not the actual tax, but this is the withholding. Because, again, the non-resident alien covered expatriate now, because no longer a U.S. citizen or resident, is going to be taxed however the person is going to be taxed. Finally, everything else, there's a giant market event in this person's life, a deemed sale, gain or loss is recognized. You have an exemption for the first $713,000 of capital gain. Everything else is taxed at the normal tax rates above that, long-term, short-term capital gain, whatever it is. This amount's indexed for inflation, so it goes up a few $1,000s every year. So that's the income tax side of things. Put all the income items into buckets, calculate the tax, and pay it. There you go. The second tax problem for covered expatriates is the inheritance tax, and I call it an inheritance tax because it's not an estate tax. It's a tax imposed on the recipient of gifts or bequests. They're called covered gifts or covered bequests. And Section 2801 is the place to go to look for this, and the basic rule is that U.S. persons who receive gifts or bequests from covered expatriates will pay 40% tax on that money received for the privilege of receiving it from covered expatriates. So it's kind of a backdoor way for the government to prevent covered expatriates from escaping from underneath the U.S. estate tax. There are proposed regulations that have been published. The form, which is going to be Form 708 when it's eventually published, hasn't been published yet. There are a few draft copies floating around the interwebs, but you can see those. And the proposed regs say, until we've finalized the regs in the form, you don't have to pay the tax. So we haven't heard yet. So here we are, late 2018. So that's the big picture. Why would you want to avoid covered expatriate status? Because you don't want to pay a massive tax, and if you are expatriating and you're leaving your kids behind and someday they're going to inherit all of your wealth, you don't want them to pay a 40% haircut on everything they receive from you. So let's move on, having done the quick flyby overview of how the tax system works for expatriation, and let's talk about some specifics. Let's talk first about what is your expatriation date. What are the things that cause you to expatriate, and when do those things happen? Here's where all the fun and game happens on the paperwork. So Form 8854, Part 1, Line 5. What is your expatriation date? And you notice there are 3 little check boxes, 1 for citizenship and 2 for long-term resident. That's because there's only one way for a citizen to expatriate, and that's by terminating citizenship. But there are 2 ways for a long-term resident, and again, think green card holder, to terminate that status. One is by changing immigration status, so terminating the visa status either voluntarily or having it taken away involuntarily. The second way for a long-term resident to terminate status is to make a treaty election on an income tax return. So we'll talk about both of those. Let's start, though, with citizens. This one is going to be a little bit murky, as you'll see, and I give you an answer to the murk. It may or may not be wrong. It may or may not be right, but it's the least bad opinion I can find. This is what I do. So let's start. How does it all work? Citizens, how do you relinquish nationality? So all U.S. citizens have U.S. nationality, and conversely, not all U.S. nationals have citizenship. As near as I can tell from the Immigration and Nationality Act and how the law stands right now, people who are born in American Samoa have U.S. nationality, but they are not U.S. citizens. But everybody else, if you're a citizen, you have nationality. And from now on out, I'm just going to be hand-wavy and just say, give up citizenship rather than be the hyper-technical thing, give up nationality, which in turn extinguishes your citizenship. So let's just talk about citizenship from now on out. So an expatriate is a U.S. citizen who relinquishes, and that's going to be the key word, U.S. nationality. And relinquish is defined by cross-reference to the Immigration and Nationality Act, which is in Title 8 of the United States Code. And there are 6 voluntary acts listed there. And you do one of those 6 acts with the intention of terminating your U.S. nationality. So it's kind of like murder, right? You kill somebody with the intent to kill them, and that's first-degree murder. You kill somebody and accidentally without intent, it's some kind of lesser crime or maybe not even a crime at all. So again, remember this, action plus intention. The most common one is renunciation. So this is when you march into an embassy or consulate abroad, you sign some paperwork, you say the magic words while holding up your right hand and looking at the flag, and you terminate your U.S. citizenship. So that's the most common one you'll see. The second most common one that I see is people who acquire a second citizenship and by doing so extinguish U.S. citizenship deliberately. So let's talk about the two categories. First, terminating your U.S. citizenship by renunciation. That's the easy one. And the second one is terminating your U.S. citizenship by one of the other methodologies listed in the Immigration and Nationality Act. So the code says the expatriation date is the date on which an individual relinquishes citizenship, and then it goes on to say the expatriation date is defined as the earlier of two events in this person's life. The actual date of renunciation, so again, that's when you're in the embassy signing the paper and saying the magic words, or the date that the State Department issues a certificate of loss of nationality. So this is the official document that says you are no longer a U.S. citizen. So here's how it works. The State Department, under its laws, says your citizenship terminates on the date of the relinquishing act. And in this case, the relinquishing act is renunciation. I choose not to be a U.S. citizen anymore. The Internal Revenue Code, on the other hand, says that the expatriation date is the earlier of the the renunciation date, or the date that the State Department issues the certificate of loss of nationality. So I'm going to ask you, on what planet will the State Department ever issue you a document saying you lost your U.S. nationality before you actually lost your U.S. nationality? So the code in section 877A, little g in parentheses, 4 in parentheses, is kind of dumb. I mean, this earlier of language is simply, irrelevant. And so for a renunciation, it's really clear. The State Department agrees your U.S. citizenship terminated on the date that you renounced at the embassy, and the IRS agrees because of this earlier of stuff that says your expatriation date is the date that you renounce citizenship. So, I mean, despite my little haggling about the language in the code, it works. So when you're preparing a Form 8854 for someone who renounced, it's the renunciation date. But let's talk about the other methods of relinquishing U.S. citizenship. And here it's not clear at all. In fact, it's badly unclear. The code 877A says your expatriation date for one of these other methodologies is the date that the individual furnishes a signed statement of voluntary relinquishment to the State Department, or the date that the State Department issues the certificate of loss of nationality. So the paperwork for the first bullet point, the individual walks in and gives someone at an embassy a signed statement. This is Form DS for Department of State 4079. You fill it in, you say, this is the action I took, and I did it with the intention of terminating my U.S. citizenship. And you give the details there, and then they go through and they decide whether they agree with you or not. So that's a paperwork event. And here's why it's not clear, and in fact I think it's kind of wrong, and it's wrong in a way that's unenforceable by the federal courts. We have 3 different dates in time. The first one is the relinquishing act. The second one is the date that the individual gave the Form DS 4079 to the State Department saying, hey, I took a relinquishing act voluntarily with the intention of terminating my U.S. citizenship. And the third date is the certificate of loss of nationality is issued by the State Department saying they agree with you that you've terminated your U.S. citizenship. So the question is, which one of those three dates is your expatriation date for Form 8854 Line 5 purposes? Again, let's go down to the bottom line. The State Department says your U.S. citizenship terminates when you commit the Relinquishing Act. Then let's go up a level to the Internal Revenue Service. The Internal Revenue Service says your expatriation date, the date on which you extinguished your citizenship, you relinquished your citizenship according to Section 877AG3, is the earlier of the date that you gave the piece of paper to the State Department or the date that the certificate of loss of nationality was issued. So look at that little gray arrow down at the bottom. Sometime between the date of the Relinquishing Act and the date that you got into the embassy and gave the State Department a piece of paper saying, hey, I terminated my U.S. citizenship, you're in a gray zone. Are you a citizen or not? The State Department says you are not. The IRS says you are. So what do you put on line 5? So here's an example, and this is an example that is more common than you would imagine. And it mostly comes up in Canada as near as I can tell. So in the late 60s and early 70s, a lot of Americans moved north of the border, and they stayed long enough until they acquired the right to apply for and receive Canadian citizenship, and many, many, many of them did. So sometime starting in the mid-70s towards the late 70s, you see a lot of people who acquired Canadian citizenship. They did the oath and all of that fun stuff. So let's just take one of those people. In 1978, this person becomes a Canadian citizenship and swears allegiance to the Queen and all that fun stuff. And you intend by doing that to terminate your U.S. citizenship and stay in Canada forever. In 2018, you get around to doing the paperwork. You give a Form DS-4079 to the State Department, somebody at the local embassy or consulate, and you say, hey, in 1978 I became a Canadian citizen, and I intended to terminate my U.S. citizenship, and therefore my voluntary act terminating U.S. citizenship occurred in 1978. In due course, the State Department agrees with you, issues the certificate of loss of nationality, and says, we agree, you stopped being a U.S. citizen in 1978. So the big question for Form 8854 is, what's your expatriation date? What do you put on line 5? And I think the answer is 1978. See, because otherwise you have 1978 until 2018, so 40 years of ambiguity where the State Department says you are not a U.S. citizen, and the Internal Revenue Service says you are a citizen and you should have been filing income tax returns. And because you expatriated in 2018, we want a Form 8854. So what happens for someone who moved north of the border and became a citizen of Canada in 1978, and they were stony broke, and then they start a business, and hey presto, they have a net worth of $20-30 million at that point. Are they going to pay an exit tax? This is kind of the nub of the whole question here, because if you can say I expatriated in 1978, then you don't have 40 years of tax remedial work to do for the IRS, and you don't have an exit tax problem. I think that the Internal Revenue Code is wrong on this point. And I think the reason is we can point to a recently repealed, 10 years ago, part of the code, Section 7701N, like November. And this is a piece of the old exit tax rules, Section 877A stuff, that was repealed in 2008. And it explicitly said that you remain a citizen, for tax purposes at least, until you tell the State Department and you tell the Internal Revenue Service. Now, implicit in that repeal, I think, is that Congress realized that they can't tax you as a U.S. citizen unless you really are a U.S. citizen. And I think when I say they can't, it's either because it's unenforceable for legal reasons. I mean, think of yourself standing in front of a U.S. federal court judge and saying, hey, the State Department says I'm not a citizen, but the IRS says I am a citizen. What gives? I kind of think a judge is going to side with the State Department. So I think the law may be wrong there, or for practical reasons. I mean, think of this. I mean, someone who expatriates in 1978 and they don't file the paperwork for 40 years. I mean, is Canada going to enforce a tax liability and collect money for the IRS in such an ambiguous state of affairs? I kind of doubt it. Here for your reading pleasure on slide 24 is the old language from 7701, and you notice that A and B say you have to give notice of the Expatriating Act to the Secretary of State, that's DS 4079, and provide a statement to the IRS, which is Form 8854. And under the old rules said, no, we're going to keep taxing you as a citizen until you do both of these things. And that's gone now. So my conclusion here is that the expatriation date should be the date of the voluntary act that caused the U.S. citizen to lose nationality. That's what goes on line 5. And here's what I do. You know, it's just a warning. It's my opinion. It's not the word of God. But having said that, I have done these kinds of Form 8854s. I have followed this strategy, and knock on wood, so far it's worked. At some point, I suspect either the law will be fixed or regs will be issued or something like that, and this ambiguity will be solved. But for the moment, I'm using the Relinquishing Act. I'm following the Immigration and Nationality Act because, come on, that's the defining rule in federal law for who is a citizen, who is not a citizen. All right, that's citizens. Ambiguity solved. I hope I'm right, and let's see what we do with long-term residents now. So long-term residents, there are two methodologies for terminating resident status and therefore knowing what your expatriation date is. One of them is giving notice to the Department of Homeland Security, and code word for filing a Form I-407, or the second one that we'll deal with in a second is a tax election that if you make it, it will be a deemed expatriation. What is a long-term resident anyway? A long-term resident is a combination of status. You've got the visa status that we commonly refer to as having a green card, plus you have time. So this in at least 8 years in the previous 15 years. And it doesn't take 8 years of days worth of time. In other words, it's not an elapsed time kind of test. Think of it more like one tax year at a time. And if you have this status for at least a brief glimmer of a moment in a particular tax year, you toggle 1 on your counting towards your magic 8 that makes you a long-term resident. And in fact, 6 years and 2 days of elapsed time is all you need to become a long-term resident. So let's look at this. Assume that you get your green card status on December 31, 2011. You had it for a day. In 2011, you had this status. So you toggle 1 towards your magic 8 that you're counting. And then 12, 13, 14, 15, 16, 17, you stay in the United States the whole time. So these years count. And on January 1, 2018, you are a lawful permanent resident in the tax year of 2018. So now you have the magic 8 years. So the bottom line, here we sit October 19, 2018. Anyone who received green card status in 2011, barring some things that I'm going to talk about in a second, that person is going to be a long-term resident and therefore has to wrestle with the exit tax when they terminate their visa status. And I said there's a little bit of an out because what would a tax rule be without an exception? So we've got one. And it says that as you're counting towards your magic 8 years that you have to accumulate in order to become a long-term resident, if you bail out of the United States for a year and for the entire calendar year that you're outside the United States, you make a treaty election to be taxed as a non-resident alien of the USA and a resident of the other country that you're living in, then you don't count that year towards your 8 out of the last 15. So let's see our example again. Again, we have someone who came to the United States, got a green card on December 31st, 2011. 2012, they're in the United States all year. 2013, they are outside of the United States all year. And when it comes time to filing an income tax return in the United States, person makes a treaty election, Form 8833, claims non-resident status in the United States and resident status in the country where this person is living under the relevant income tax treaty. And it works and it's fine. They file a 1040-NR. Then the person comes back to the United States and stays. So you can see here that we omit 2013 in counting towards the accumulated 8 out of the last 15 years. So in calendar year 2018, this person has only achieved 7 years towards the 8, and therefore is not yet a long-term resident in calendar year 2018. So that's how you become one. Now let's say you are a long-term resident. How do you terminate that status? And there are two ways. We'll talk about the tax way in a second, but here's the visa way to terminate your long-term resident status and thereby become an expatriate. You can abandon your visa status, say, I don't want to live in the United States anymore as an immigrant. I file Form I-407 and I'm done. So that's voluntarily. The government can take your green card away from you. And this is called revoking the green card, and they start administrative proceedings. You might go to court at the end to challenge the administrative decision to terminate your visa status. But one way or another, it's being forced upon you, and you lose at every step, administratively and in the courts, and eventually your visa status ends, revoking. But critically, your green card expiring is not a termination of your visa status. So think about it this way. If you're a U.S. citizen and you get a passport and it's good for 10 years and the passport expires, have you stopped being a U.S. citizen? Answer is no. You're still a U.S. citizen, you just have an expired passport. It's the same thing with somebody who is a lawful permanent resident. In other words, they came to the United States, they got the green card status. They have the visa status of being allowed to live and work in the United States forever and ever. As a little souvenir, they get a little green card, and it says, here's my face and here's my identifying information, and it has an expiration date on it. The expiration date does not terminate the visa status. It just means it's time to go to get another little souvenir of your green card status, your visa status. So there are many, 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 and I'm going to guess thousands of people living abroad who left the United States, never formally canceled the visa status by filing Form I-407, and in due course the green card expired, and they assume that they are out of the tax system, but they are not. From a technical point of view, the immigration status is still that of a lawful permanent resident of the United States, and therefore the technical tax status is you are a U.S. taxpayer. So a critical thing, just because the green card expires doesn't mean you're out of the U.S. tax system. You have to do the paperwork. The expatriation date, meaning the date that your visa status terminates, is either the day that you hand in your I-407 at the embassy or consulate, or if you go through a bunch of administrative and judicial hoo-ha, it's the date of the final order. So though that is an easy date to figure out. You can mail in the I-407 to an embassy or consulate. My practice is I like people to go in and actually do it so we can definitely say there's a day. And especially if you're doing this late in the year and it's important for you to have your visa status terminate because you want to expatriate in a particular calendar year, you don't want any delays. Is the mail going to be slow? Once it arrives at the embassy, will it take them a while to open the envelope? Once the paperwork sits on somebody's desk for a while, will it take a while for them to process it? Or is a person on vacation? And hey, presto, you've blown your expatriation date that you wanted to do in 2018, and you've got an expatriation date in 2019, which may make some messes for you. So just go in, do it. All right, So that's terminating with abandoning the visa. And by far, the most people that I see are people who voluntarily terminate the visa, hand in the Form I-407. I think I've only ever seen one person who has had the termination forced upon them, and this is somebody who lived outside the United States for a long time, did not renew the visa and all that fun stuff, flew back to the United States, and at the border, our friendly person with a gun on his hip said, "No, you've been out too long." She objected, she fought for a long time, and eventually lost. So by far the most common way is going to be the voluntary way. So the second way for a long-term resident, again, think green card holder, to terminate that status and make an expatriation date for themselves is by making the treaty election to be taxed as a non-resident of the United States and a resident of some other country. And here from the code is what it says. And any long-term resident who ceases to be a lawful permanent resident, as defined in the code, 7701B6, that is an expatriation date. And so if we go and we look at 7701B6, this is what it says. It says you are going to stop being a lawful permanent resident if you start being treated as a resident of a foreign country under the provisions of a tax treaty, you don't waive the benefits of that treaty, and you notify the Secretary, meaning the Secretary of the Treasury, meaning the IRS, of the commencement of such treatment. So commence to be treated as a resident of the foreign country. If you look at every tax treaty, it says you figure out whether someone is a resident of a particular country by looking at the domestic tax laws of that country. So if you move to Italy in March, you look at the Italian tax laws that define who is a resident for tax purposes, income tax purposes of Italy. And if Italian law says March 1st is your date, then that's your date under the terms of the tax treaty. That does not waive the benefits of such treaty. Let's just ignore that stuff because it's not important here. And then the third requirement notifies the Secretary of the commencement of such treatment. Government says, we don't want you to become a non-resident alien until you tell us. And until you tell us, we'll assume that you continue to be a U.S. taxpayer. So the way that you tell the IRS that you are commencing to be a resident of the other country is by filing Form 8833, the treaty election form attached to a tax return. So what this says is when you file a tax return with Form 8833 attached to it, you are ceasing to be a lawful permanent resident. And we know that if you cease to be a lawful permanent resident, you expatriate. And the critical problem here is what is the date that you commence to be treated as a resident of the other country? So note that it's not necessarily January 1. So you may have a problem with a starting date kind of mid-year. So this is going to be the only ambiguity when you're trying to fill in line 5, what is the date that you commence to be treated as a resident? You're going to have to figure that out under the domestic tax law. Anyway, so here's where we are. A citizen has given up citizenship, and we know the date that it happened, either because it's renunciation and the law is clear, or because it's giving up citizenship by another method, and we chose the date of the voluntary act because the Internal Revenue Code is murky. We know that we have an expatriation event, and we know the date of it because we have a long-term resident, and they either filed Form I-407, handed it in, or a judge said you're no longer an immigrant, a lawful permanent resident of the United States, and we have a date for that. Or the person filed a U.S. income tax return with a treaty election, and the starting date for residency in the other country is a known number, and you put that date in. So we have the expatriation date, we have the expatriation event, and congratulations, this person is now an expatriate. Has to file Form 8854, but we don't know about tax yet. So let's move on to the are you supposed to pay tax? And for here we have 3 tests and 2 exceptions. Here's my little handy-dandy flow chart, and this is why you know I'm a tax lawyer and not a graphic artist, because this is not my finest work. Anyway, let's start. So if you look at the line, the horizontal line with the 3 gray diamonds, those are the 3 tests that you have to pass in order to not be a covered expatriate. So the first diamond, Title 26, that's the certification test. The next one to the right, the net worth test, and the final one is the income tax liability test. So we start, and I've laid it out in a different sequence from the form because the knockout punch here is the certification test. If you fail the certification test, meaning your 5 prior years' tax obligations are not fully satisfied, you are an instant covered expatriate. So I've seen this where the worst situation was someone, the only asset they had in the world was a little IRA with $60,000 in it, but because the prior 5 years' tax filings were not in the books and taxes paid, this person was a covered expatriate. They had a deemed distribution of that $60,000 IRA, and they had $60,000 of taxable income as they gave up citizenship. And that's pretty grim. And somebody with 60 grand to their name should not be paying tax. But that's the way the certification test works. So but let's say that you pass that. The prior 5 years of tax obligations are okay. We move on to the net worth test. If your net worth is under $2 million, yes, we move on to the net tax liability test. If your net tax liability is under the threshold for the year that you expatriate in, then you're not a covered expatriate. If you fail either the net worth test or the income tax liability test, you go down and you say, does an exception apply? And there are 2 of them, and if one of those 2 exceptions applies, you're not a covered expatriate. And if neither applies, then you are a covered expatriate. So the first one, the certification test, are you a bad person? Did you not do all of the stuff that the law wants you to do? The next 2 are you rich enough that we're going to bother taxing you? And then I guess we have to be fair. And so we have a couple of exceptions in the name of fairness and justice and all that fun stuff. And that's the way that the tax code is set up to determine whether you're a covered expatriate. And Form 8854 Part 4, Section A, is where all the magic happens. So let's walk through this and how you fill it in one at a time. The net income tax liability test is line 1, and you fill in your U.S. income tax liability for the 5 prior years on these lines, and you're done. It doesn't ask you to do the math and compute the average for the 5 years. It just asks you to fill in the raw data, and I guess they figure it out, and they calculate the average later on their own time. The average for 2018 expatriations is $165,000. This adjusts annually for inflation, so it's going to go up a few $1,000s next year, and the year after that, blah, blah, blah. How do you calculate the net income tax liability for each of the prior 5 years so you can then compute the average? Well, the average is add the 5 years together, divide by 5. That's easy. But in order to compute the income tax liability, you're told to go look at Internal Revenue Code Section 38C1. And important points here, there's a lot of add this and subtract that, mostly having to do with tax credits. The important points for your purposes, if you're eyeballing somebody's prior year, five prior years of tax returns, is don't include net investment income, the investment income tax income, the Obamacare stuff. Don't include self-employment income. Do include AMT. And give full credit to the foreign tax credit. So that reduces your tax liability. And for most people living abroad, if they're paying foreign tax, this is going to be a pretty well guaranteed way to bring their average U.S. tax liability down below the $165,000 mark. Even if they're making $5 million a year and paying a boatload of tax in the other country, they're going to get a foreign tax credit, reducing their tax liability effectively to 0 in the United States. So that's how it works. It's a little bit of work for working your way through the Internal Revenue Code Section 38C1 stuff, but it can be done. There's a little wrinkle here, which is a kind of a pain in the neck, and that is for people who filed married filing jointly. If you have a married filing jointly situation and the taxpayer, either one or both of them, wants to expatriate, and you're trying to calculate the average tax liability for this person, you don't divide the tax liability on that income tax return, the joint tax liability, you don't divide it by 2. You take the whole dollar amount. And so I'll give you an example later in the strategy situation where it becomes important, if you want someone to expatriate and not be a covered expatriate and not trip over this rock in their path, to get them on the path of married filing separately for a while. Anyway, that's the income tax liability test. The next one is the net worth test. And the net worth test is your over-under is $2 million. This is not indexed for inflation for reasons unknown to me, but there you have it. And how do you figure out whether an asset is included on the balance sheet for the expatriate? And the answer is you look at it and say, would this be a taxable gift if I gave it away and if I were a U.S. citizen? And if so, this is going to go on your balance sheet as something that belongs to you. And you ignore the small gifts and the gift to spouses and all of these exceptions. It's just take the basic concept, is this taxable gift? Yes, no. There's an addition where you also are required to include as an asset the value of the beneficial interest in trusts. And I've given reference to the notices that are relevant there and gives you some idea about how to calculate, what's your beneficial into the trust and how much is it worth. And finally, you subtract liabilities to get net worth. Interestingly, there's a fair amount of stuff in the code and these notices about assets and how to value them. Is it yours? Yes, no. There's absolutely nothing written about liabilities. Is this your liability? Yes, no. So it's kind of an interesting omission. Maybe someday this will be filled by regs or notices or whatnot, but at the moment, dead silence. So line 1 and 2, let's just recap where we are right now. These are the 2 tests that say you are so rich that we want to tax you before you leave the U.S. tax system, either because you're rich indirectly because you had a lot of tax liability, therefore you must be rich, or you're rich based on your balance sheet. Now let's talk about 2 exceptions, and these are lines 3, 4, and 5. Lines 3 and 4 have to do with dual citizens, and line 5 has to do with young people, someone who expatriates before age 18 and a half. The dual citizen exception has 2 parts, lines 3 and lines 4. And the dual citizen exception law says you became a citizen at birth simultaneously of the United States and another country. And as of the expatriation date, you continue to be a citizen of that country. And as of the expatriation date, you're taxed as a resident of that country. Let's break this down and see what it means. Became a citizen at birth. So this immediately knocks out anybody who is a dual citizen by naturalization. If you look in the U.S. Immigration and Nationality Act, I forget which one it is, I think it's Section 322, it talks about how a kid born abroad to a U.S. citizen parent who is married to a non-resident alien, how does that person become a citizen? And the answer is, in one weird situation, that kid does not automatically acquire U.S. citizenship, but instead acquires the right to become a citizen by naturalization. So you have to look carefully at the immigration rules in the United States and the immigration rules in the other country to ensure that by law this person automatically became a citizen of both countries at birth. It doesn't really matter if the paperwork took a while to complete. It's the moment of birth, did you have that right? The second part of the dual citizen exception is you continue to be a citizen. Now, I've never seen anybody give up citizenship of another country and then reacquire it. But Section 877A seems to imply that you had to have continuous citizenship from birth in that other country. And finally, at the expatriation date, continues to be taxed as a resident of that other country. Now, I'm not sure whether they mean you were taxed since birth as a resident of that other country, or continues to be taxed as a resident of such other country means at the expatriation date you are taxed as a resident of that other country. So there's some ambiguity there, and there's a second ambiguity because God help us, and I wish I lived there. Not really. Some countries have no income tax. And how can you be taxed as a resident of a country that doesn't have any income tax? I don't know the answer to that. I can tell you that I've done many expatriations for people who live in countries like that, typically in the Middle East, where there is no income tax, and we have used the dual citizen exception, and it has worked. So I think the intention is not that the only people who can use the dual citizen exception are people who live in countries that have an income tax. I think any dual citizen who's a dual citizen of any of the United States and any other country can use it. They just want you to be sort of like a theoretical income tax resident. If this country, if Saudi Arabia had an income tax, you would pay the income tax there. So that's an example. So that's what it takes to acquire dual citizen exception status. And if you do that, it doesn't really matter whether you're worth $5 or $5 billion, you may qualify to be able to expatriate and not be a covered expatriate. Line 4 is the second barrel of this double-barreled shotgun for what you need to satisfy in order to use the dual citizen exception, and that's a residence test. You can't use this dual citizen exception if you've lived in the United States too much in the previous 15 years. And to figure out whether you've lived in the United States too much in the last 15 years, you use the regular old substantial presence test under Section 7701. And you just look at the 15 years that ends with your expatriation date, and you say, applying the expatriation date, was I a resident of the United States in not more than 10 of those years? So that's your test. So you'll do a little bit. In most cases, this is blindingly obvious. The person has been living abroad for the whole period or almost of the whole period, and so it's not an issue. The second exception is for a person who is a young person. If you are under age 18 and a half and you expatriate, it doesn't matter how rich you are or how much tax you paid. You can expatriate and not be a covered expatriate. And again, it's a double-barreled test. You relinquish U.S. citizenship before age 18 and a half, and same substantial presence test and not more than 10 taxable years before the date of the relinquishment. So either you satisfy it or not. I've done these things, and in fact, someone who's under age 18 can expatriate, and I've done it principally through the London Embassy. And what ends up happening is after the kid turns 18, the embassy will circle back and say, did you really mean it? If so, affirm it, and then you're done. Because from age 18 to 18 and a half under Immigration and Nationality Act, the minor who relinquished citizenship has a right to rescind that relinquishment. So those two, if you are exceedingly wealthy and you satisfy those two exceptions, you can still not be a covered expatriate, but for this final test, and this is the most important one, the certification test. Certification test says, I've satisfied everything I'm supposed to satisfy for the previous 5 years under Title 26, the Internal Revenue Code. And I give you a little bit of stuff there for tax nerds only, where you can look at the difference between Internal Revenue Code versus Title 26 versus statutes at large, which is the definitive baseline, this is what the federal law is, versus uncodified tax law. Uncodified tax law is something like, this Section 530 stuff where they define what's an independent contractor versus employee, and that's just buried in a footnote somewhere. Anyway, the certification test. The hard part is, what does it mean? How do you satisfy this thing, and when do you know you've satisfied it? Because everybody knows you make minor mistakes on your tax return, and it's a no harm, no foul kind of situation. So does the certification test mean you can't even have minor problems, or does it just mean that you have major compliance failures? And if it's just major, how big is major and how big is minor? How do you know? And nobody knows the answer. We haven't heard anything from the government yet on the certification test and when you've satisfied it and when you haven't. And here's what I think. If you haven't filed a form, but it applies to your life, like Form 8621 for PFICs, Form 3520 for foreign trusts, Form 5471 for controlled foreign corporations, but you didn't do it, I think that's a problem. Fix it. I also think it's a problem if you did something or didn't do something and the non-compliance penalty is big, big dollar number, or it creates an open statute of limitations. I kind of think that's a signal from Congress saying this is a significant compliance problem, and I think you've got to fix it in order to fix the certification test. And then finally, obviously, if you can be indicted for perjury, that's an obvious problem, so fix that. But small stuff, Streetcar Named Desire, Blanche Dubois, I've always relied on the kindness of strangers. Don't do that. Just fix everything. Finally, let's move on and let's wrap up with what do you do to fix the problem or prevent the problem? How do you stop being a covered expatriate? You know you're going to have paperwork, but let's see if we can prevent or at least reduce tax liability. The first obvious one is if you are not a citizen, just try to prevent becoming an expatriate. And the way that you prevent becoming an expatriate is you don't get a green card. You get a Category E visa, you get a Category L visa, you get some other kind of visa status to live in the United States, but you do not get a green card. If you do get a green card, that 8-year clock is your limit. So somewhere before the 8 years hits, you've got to make a decision and make a move. Abandon the green card, get out of the country, or if you're lucky, get out for a while, make treaty elections to be a non-resident, and postpone that date. But sooner or later, that 8-year number is going to hit, and you're either locked in or not. So that's your first step. Everybody else, let's see if we can avoid one of these 3 tests, because you want to pass all 3 tests, and if you pass them, then you don't become a covered expatriate. For the net tax liability test, the only thing that I know to do is to start converting from married filing jointly to married filing separately. And you got a little math here. Someone who wanted to expatriate in 2016 would have an average married filing jointly of $200,000, so obviously would trip over that rock and become a covered expatriate. But they start in 2017 filing married filing separately, and the average becomes $180,000, and then they married filing separately, filing again in 2018. And the 5-year average is now $160,000 under my example, and now we're below the threshold, which means that this individual can expatriate in 2019 and pass the net income tax liability test. So look at strategies to reduce your rolling average to below the threshold. The net worth test, the big game is gifts. So here I've got an example. Husband and wife have a net worth combined of $6 million, split 50-50. I have the husband expatriating. He gives enough assets in cash to his wife, and now his net worth is $1.9 million below the radar. Easy peasy. So this is the game that you play, but there's some treachery involved. The first one is that the marital deduction for gifts in the gift tax rules does not apply to non-citizen spouses. So if you're making a gift to a non-citizen spouse, you're going to have to use the unified credit. The second thing is you have a gift tax risk for the unified credit. The critical thing is that the unified credit that you're entitled to is the value that you're allowed on December 31 of a particular tax year. If you expatriate in that tax year, your unified credit available is 0. So if you make a gift in the year that you expatriate, you have no unified credit to absorb any gift tax liability. So the moral of that story is if you are going to use the unified credit, give money, file a gift tax return using the unified credit in year 1, expatriate in year 2. Another problem with gifts. Capital gain tax risk. And this is a situation where we're swapping assets around because we want the individual who's expatriating to have high basis, low gain assets. So if there's a mark-to-market problem, there's not much capital gain tax to pay, assuming this person's a covered expatriate. So think of 50-50 ownership of all the assets. Wife gets all of the house, husband gets all of the money in the bank account. Mark-to-market on money results in zero gain. No exit tax problem under the mark-to-market part of it. And Section 1041 normally makes swapping of assets back and forth between spouses totally non-taxable. For our purposes here, non-resident alien spouses don't get that, so the basic rule is off. And the way I solve it is by making this election under Section 6013, so the non-resident alien spouse becomes a resident for the year that you're doing all this asset movement around. Therefore, 1041A, the basic general rule, tax-free swaps between spouses will apply. The final one, which is actually kind of cool, is green card holders abroad. If they only get taxed on gifts of assets in the United States of U.S. real estate and tangible personal property. Tangible personal property are things that you can hold and touch. But so all foreign assets is just simply not within the definition of a taxable gift for U.S. purposes, so they can dump everything. You don't even have to file a gift tax return to report it. So this is an interesting thing to help a green card holder who's living abroad to avoid the net worth test. Covered expatriates. If you are a covered expatriate, you want to minimize the mark-to-market gain by moving assets around. So I gave you an example where the non-resident alien spouse gets the house with the capital gain built in, and the expatriating husband gets all the cash with no gain in it. Therefore, even though this person is a covered expatriate, there's going to be no income tax on the way out of the system. The other thing you need to do is look at the foreign tax credit on the other side, because remember, the exit tax is a phony baloney made up deemed tax in the United States, but there's no recognition event. And this creates a problem because when you're paying tax in the other country, you don't have the ability to use the foreign tax credit in the other country for the U.S. exit tax paid. Two examples: real estate. So someone is an expatriate, has real estate in France, expatriates, pay mark-to-market tax on the built-in capital gain on that French real estate. A year later, this person sells the French real estate for cash, and French law says pay tax on the capital gain. There's no ability to take a foreign tax credit in France for the exit tax, mark-to-market tax paid to the United States. Big problem. You need to engineer a recognition event in France in order to use the foreign tax credit. Another one, and this is much worse, is remember we talked about ineligible deferred comp plans. So this has a giant mark-to-market, well, not a mark-to-market, a lump sum distribution of the present value of the vested pension benefits. So as this person is leaving the U.S. tax system, they pay an enormous tax on the pension. And then years later, when the person retires, tax is going to start being imposed on the pension benefits received. And effectively, there's double tax on the pension benefits, which means that the individual is going to get largely zero for the pension that he or she worked for all of his life. This problem has been solved between the United States and Canada, and I give you a reference to the RevProc and the treaty for how this works. And effectively it says if you have a departure tax in Canada or an exit tax in the United States, you can make an election in the other country, and we'll treat it as a deemed sale in the other country, and that allows you to use the foreign tax credit and gives you a step up in basis in the asset. But for all other countries, this problem has not yet been solved. So I suggest you, if you have a covered expatriate, look carefully at that. Thank you. That's the end. This is not a Circular 230 warning. Thanks for listening, and give me a call if you have any questions. See you next month.